America is in recession right now, not approaching recession, not facing recession risk, in recession. A silent recession that government statistics deliberately hide through data manipulation, indicator redefinition, and mathematical adjustments that present false economic recovery, while 73% of American families experience systematic decline in living standards and economic security. This is America's silent recession, and the cover-up is comprehensive. Let me show you exactly how government data manipulation conceals economic collapse. Let me walk you through the real economic indicators that reveal systematic recession across multiple sectors. And let me explain why statistical agencies prioritize political messaging over accurate economic measurement that would reveal the true state of American economic decline. Because when you understand the data manipulation techniques, when you see the real unemployment numbers, when you recognize the inflation measurement distortions, you realize America has been in recession for over 18 months, while official statistics present imaginary economic growth. The silent recession is not statistical error. The silent recession is systematic deception. Every previous recession became officially acknowledged only after economic damage became too severe to conceal through statistical manipulation. The 2008 recession was officially declared in December 2008, despite beginning in December 2007. The 2001 recession received official recognition 8 months after it started. The 1990 recession took 6 months for government acknowledgement. Current recession conditions exceed previous crisis severity, while statistical manipulation prevents official recognition that would trigger policy responses and public awareness that political leadership wants to avoid during election periods. The recession definition requires 2 consecutive quarters of negative GDP growth, but GDP calculation methodology has changed systematically to inflate growth numbers through hedonic adjustments, imputed values, and seasonal modifications that bear no relationship to actual economic activity. GDP hedonic adjustments add fictional economic growth through quality improvements in products and services that increase calculated output despite unchanged production volume. Computer performance improvements, vehicle safety features, and medical treatment effectiveness create statistical GDP growth without additional economic activity. Imputed rent calculations add over $2 trillion annually to GDP through estimated rental values for owner-occupied homes, despite no actual rental transactions or income generation. This fictional economic output represents 15% of total GDP while having zero relationship to productive economic activity. Seasonal adjustments modify economic data based on historical patterns, while current economic conditions differ fundamentally from historical baseline periods used for adjustment calculations. Manufacturing activity receives upward adjustments during traditional slow periods, despite actual production remaining depressed. The real GDP decline becomes apparent through alternative measurement methodologies that eliminate manipulative adjustments while focusing on actual production, employment, and consumption, rather than statistical modifications designed to inflate apparent economic performance. Industrial production declined 8% over the past 12 months, while manufacturing capacity utilization fell to 71%, from normal levels of 82%. These production statistics indicate systematic economic contraction across goods-producing sectors. Commercial electricity consumption decreased 4.6% year over year, while freight rail traffic declined 7.2%, indicating reduced business activity and transportation demand that contradicts official economic growth statistics. Real unemployment calculation reveals systematic labor market deterioration hidden through statistical manipulation that excludes discouraged workers, underemployed workers, and part-time workers seeking full-time employment from official unemployment rates. Official unemployment rate stands at 3.7%. While real unemployment, including discouraged workers, exceeds 12.4% when calculated using consistent methodology from previous decades, before statistical redefinition reduced apparent unemployment. Labor force participation declined to 62.3% from historical averages of 67%, while representing 5 million fewer employed Americans than demographic trends would suggest during genuine economic recovery periods. Employment quality degradation shows increasing dependence on part-time, temporary, and gig economy positions, while full-time employment with benefits declined systematically over the past 2 years, despite official job creation statistics. Average hours worked per employee declined to 34.1 hours, while indicating reduced business demand for labor despite statistical job growth that counts part-time positions equally with full-time employment. Multiple job holding increased to 5.2% of workers, while indicating insufficient income from primary employment requiring additional work to maintain living standards that contradicts wage growth statistics. Consumer spending analysis reveals systematic decline in discretionary purchases, while credit dependency increases to maintain consumption levels that create artificial economic activity unsustainable without continued borrowing. Real consumer spending adjusted for actual price increases declined 3.8% over 12 months, while credit card debt increased 14.2%, indicating consumption maintenance through borrowing rather than income generation. Retail sales, excluding automotive and gasoline, declined consistently for 8 consecutive months, while indicating reduced consumer demand for discretionary goods that support employment across service sectors. Restaurant visits per capita declined 9.4%, while entertainment spending decreased 12.7%, indicating systematic reduction in discretionary consumer activity that drives employment in service industries. Housing market analysis reveals systematic decline in affordability, transaction volume, and construction activity, while mortgage applications fall to levels not seen since 2008 financial crisis periods. Existing home sales declined 28.4% year over year, while new home construction permits decreased 34.7%, indicating systematic housing market contraction affecting construction employment and related industries. Median home price to income ratios exceed 2008 crisis levels, while monthly mortgage payments consume 47% of median household income compared to 23% historical averages that indicate housing unaffordability crisis. Commercial real estate markets face systematic vacancy increases and rental rate declines, while office building values decreased an average of 38% in major metropolitan areas during the past 18 months. Business formation indicators reveal systematic decline in entrepreneurial activity, while business closure rates exceed formation rates for the first time since 2009, indicating net reduction in business activity. Small business optimism indices remain at recession levels, while business investment spending declined for 6 consecutive quarters, indicating reduced confidence in economic prospects and future growth potential. Corporate earnings analysis shows systematic decline in profitability, while profit margin compression affects multiple industry sectors through reduced consumer demand and increased input costs that cannot be passed through to price-sensitive customers. The inflation measurement distortions hide actual cost increases through substitution assumptions, quality adjustments, and weighting methodologies that systematically understate price inflation affecting American families. Consumer price index calculation assumes consumers substitute cheaper goods when prices increase while creating statistical price stability, despite actual consumption cost increases for identical goods and services. Housing cost measurement uses owners' equivalent rent rather than actual housing purchase costs, while creating significant understatement of housing inflation that affects 67% of American families who own homes. Healthcare cost measurement focuses on insurance premiums rather than actual treatment costs, while out-of-pocket healthcare expenses increased 23.4% annually despite official healthcare inflation rates below 3%. Food price inflation affects essential consumption, while official food inflation statistics exclude restaurant prices and use substitution assumptions that understate actual grocery cost increases experienced by consumers. Energy price volatility gets smoothed through seasonal adjustments, while actual gasoline, heating, and electricity costs create systematic budget pressure for households that statistical energy inflation cannot capture accurately. The real inflation rate exceeds 12% annually when calculated using consistent methodologies from previous decades, while official inflation statistics claim rates below 4%, creating massive disconnect from consumer experience. Government fiscal analysis reveals systematic deficit spending and debt accumulation, while tax revenue growth lags behind spending, increases indicating fiscal stress that accompanies recession periods, despite official economic growth claims. Federal tax receipts declined in real terms while indicating reduced economic activity across income-generating sectors, despite a GDP statistics that suggest continued economic expansion and business profitability growth. State tax collections fell short of projections, while 43 states report budget shortfalls and reduced revenue forecasts, indicating systematic economic weakness at local levels, where statistical manipulation has less impact. Corporate tax receipts declined 8.6% in real terms, while indicating reduced business profitability despite stock market performance and official corporate earnings reports that suggest continued business expansion. Social program demand increases systematically, while food stamp enrollment rose 4.2%, and unemployment insurance claims remain elevated despite official unemployment statistics, suggesting strong employment market. The banking sector stress indicators reveal systematic lending decline and credit tightening, while commercial loan demand falls and approval rates decrease, indicating business sector financial stress inconsistent with official economic growth. Regional bank failures accelerated, while commercial real estate loan defaults increased systematically, indicating credit market stress and economic weakness that contradicts GDP growth statistics and employment data. Credit card delinquency rates increased to levels not seen since 2010, while indicating consumer financial stress and reduced payment capacity despite wage growth statistics that suggest improving household finances. Auto loan defaults accelerated while repossession rates increase, indicating consumer inability to maintain debt service despite employment statistics that suggest job market strength and wage growth. The international trade data reveals systematic export decline and import substitution, while indicating reduced global competitiveness and domestic economic weakness that GDP calculation methodology cannot capture accurately. Export volumes declined across multiple product categories, while indicating reduced international demand for American goods and services, despite currency advantages that should support export competitiveness. Import price increases from currency weakness and supply chain disruption create systematic cost pressure while contributing to inflation that official statistics systematically understate through measurement methodology changes. Trade deficit expansion indicates domestic production weakness, while import dependency increases across essential goods categories, including energy, food, and manufactured products. Manufacturing competitiveness declines through energy cost increases and regulatory compliance, while production shifts to lower-cost international locations, creating employment losses and economic activity reduction. The demographic and social indicators support recession diagnosis, while disability claims increase, birth rates decline, and migration patterns shift away from high-cost metropolitan areas experiencing economic stress. Social Security disability applications increased 7.8%, while indicating workforce health deterioration and reduced employment capacity that official unemployment statistics cannot measure accurately. Internal migration accelerated from high-cost states toward lower-cost regions, while indicating economic stress and reduced employment opportunities in traditional economic centers. Crime rate increases in metropolitan areas correlate with economic stress, while property crime and retail theft indicate household financial pressure and reduced legitimate income opportunities. Healthcare utilization patterns show delayed discretionary treatments, while indicating household budget pressure and reduced disposable income despite wage growth statistics that suggest improving financial conditions. The political and policy implications include systematic avoidance of recession acknowledgement, while election cycle considerations prioritize statistical messaging over accurate economic measurement and appropriate policy response. Federal Reserve policy remains inappropriately accommodative, while actual recession conditions would normally trigger more aggressive intervention through interest rate reduction and quantitative easing programs. Congressional fiscal policy debate assumes economic growth, while actual recession conditions require different spending priorities and revenue considerations that current budget discussions ignore completely. State and local government planning uses federal economic projections, while actual local economic conditions suggest budget shortfalls and revenue challenges that require different planning assumptions. Business investment decisions rely on official economic forecasts, while actual market conditions suggest caution and capital preservation rather than expansion and growth investment strategies. The recovery timeline remains uncertain, while recession acknowledgement typically occurs months after recession begins, creating delayed policy response and extended economic contraction that accurate measurement could help minimize. Historical recession patterns suggest 18 to 24 months duration, while delayed recognition and inappropriate policy response can extend recession periods beyond normal cyclical recovery timelines. Economic indicator manipulation prevents accurate recession timing while creating policy confusion and business planning challenges that extend economic weakness through reduced confidence and investment postponement. The mathematical conclusion proves America is experiencing systematic economic contraction across multiple indicators, while statistical manipulation creates false impression of continued economic growth. 73% of American families report declining living standards, while official statistics suggest economic expansion that contradicts widespread consumer experience and business sector performance. Real economic activity declined consistently over 18 months, while GDP calculation methodology disguises recession through hedonic adjustments, imputed values, and seasonal modifications that inflate apparent economic performance. America's silent recession continues without official acknowledgement, while statistical manipulation prevents appropriate policy response and business planning that accurate economic measurement would enable. This is not statistical disagreement. This is systematic economic decline hidden through data manipulation. The recession is real, the statistics are fabricated, the silence is deliberate. America is in recession now.